Today, fear on the floor of the New York Stock Exchange as investors worried the country is in the midst of an economic crisis unlike anything seen in
Markets
decades.
around the world are coming off the worst week since the crash of 1929. Finance Minister.
In 2020, an unprecedented pandemic caused a global economic crisis. Before that, the world also experienced a crisis in the crash of 2008. Major investment firms failed, housing foreclosures skyrocketed, and millions lost their jobs. The government played a unique role in both the cause and reaction to that crash. Have any lessons been learned? In 2008, John Allison was CEO of BB&T, one of the 25 largest banks in the country.
Nobody in my family had ever graduated from college and a professor got me very interested in finance, and that's how I ended up going in the banking business.
Today, Allison is retired as CEO. He's an author and educator and often lectures on the lessons to be learned from the 2008 crisis.
One of the roles of banks is to help people save money and at the same time help people buy things they want, like automobiles and houses or businesses to start up. So banks get deposits from people that have extra money at the time. A lot of times it's older people, and then they lend money to people that need it. They want to buy a car, they want to buy a house, or they want to start up a business. And that really helps the economy function. People have different stages in their lives when they have extra money because they've been saving, or when they need money. A lot of times it's younger people need money to borrow to get started, and older people have excess money. The older people benefit by putting the money in the bank and getting an interest rate on their money, which helps them pay for their retirement. The younger people benefit because they can get a car now when they might not be able to get a car for 10 years, and they need the car to go to work. And so it's a healthy relationship. There are no healthy economies when there aren't healthy banks, because banks are in the business of bringing savers and borrowers together in a way that they couldn't do it individually. They don't know each other, and they don't have contacts. And that's one reason the U.S. economic system has been so productive, because we've had a better banking system. Well, the two basic criteria in deciding a loan is, first, can you pay it back? Have you got enough income to pay it back or other assets to pay it back? And secondly, will you pay it back, which is what's called character. In my experience, character is number one on the list. I wish in a way I had a more fun subject to talk about than the financial crisis, but it's actually a very important subject. Whether you know it or not because of your age, I am sure it had an impact on your family and your family's friends. It was a dramatic event, a very dramatic event. And if we draw the wrong conclusions, we're going to make the same mistakes again. And the thing that hurt people the most was in the housing market.
Part of the origins of the crisis can be traced back to Freddie Mac and Fannie Mae, a pair of federally created lending institutions.
In the early 1990s, President Clinton demanded that they start having half their loans in what was called affordable housing, now called subprime lending. And a lot of economists said, wow, that's risky.
With the backing of government lenders and financial institutions, banks dramatically increased their number of subprime loans given to people with low credit ratings. Soon it became much too easy for people to borrow more than they could afford, making what the government called affordable housing loans, which actually were unaffordable to the borrowers, became a big business.
Risky mortgages. Those loans are expected to cost 2 million people their homes before it's all done.
I shouldn't have even been offered this mortgage. It's a subprime mortgage. It's a lifetime invested here. It's like, it's a nightmare.
Predictably, as more money came into the housing market due to the subprime loans, housing prices went up.
So the prices got so high, they had to break. And when they broke is when the big correction happened. A subprime loan is a very risky loan that the probability of the borrower being unable to pay the loan or unwilling to pay the loan is way above average. Banks have not traditionally been in the subprime lending business, but there was a lot of pressure from the government to encourage banks to do riskier loans, in theory to raise the percentage of people that owned houses. But the effect was not good because a lot of people bought houses that couldn't afford them, and that ended up badly. Well, a lot of banks tried to sell these loans to government agencies, particularly two big entities that have the name Freddie Mac and Fannie Mae, that are financed by the taxpayers, and they tried to shift the risk to Freddie Mac and Fannie Mae instead of holding the loans themselves. The Great Recession was really caused by what I'll call good intended government policies. First were errors by something that sounds pretty esoteric, the Federal Reserve. The Federal Reserve owns the monetary system in the United States. They own all the money. They're like the federal government owns the interstate highways. And they made a number of mistakes that encouraged people to make bad decisions. And the second factor was government housing policy. Again, that was intended to encourage people to buy houses, but it actually encouraged people to buy houses that couldn't afford them, to buy too big of houses, and resulted in way too much investment in housing, which actually made the economy less efficient and less productive.
This morning at the opening bell, the Dow took a steep dive in what seemed for a time like near panic selling.
In 2008, we really needed an economic correction because we'd overinvested in housing. What we didn't need was a crisis, and the crisis was almost totally created by government's arbitrary handling of problem situations. Unfortunately, a number of large banks made mistakes. If I'd been in charge, I'd have let them fail. But the government didn't want these big banks to go broke because of the cronyism that exists in our economy.
Not since the Great Depression has the federal government stepped in to help a failing financial institution in this country the way they did over this past weekend.
For example, the first company that got in trouble was Bear Stearns. They were nice people who'd made some bad mistakes, but they certainly were not critical to the marketplace. The marketplace was stunned when the Federal Reserve essentially bailed out Bear Stearns. And then later on, Lehman Brothers, which was much more important than Bear Stearns, got in financial trouble. They allowed it to fail.
Sunday night, a sign of the extraordinary times on Wall Street as thousands of Lehman Brothers bankers packed their boxes.
The market believed that Paulson, who was the Secretary of Treasury, had a lot of animosity against Lehman Brothers. These government bureaucrats can just make it up however they want to make it up. But how do you deal with there's no rule of law? And that's what took a correction and turned it into a crisis.
Government interventions became chaotic.
Wachovia was essentially taken over by the Federal Reserve and sold to Citigroup. But everybody in the market knew that Citigroup was in more financial trouble than Wachovia. So this is crazy. You're selling a bad bank to a worse bank? How's that supposed to work out? And a few days later, they ended up selling Wachovia to Wells Fargo. They just reneged on a legal contract they had signed with Citigroup. They just said, sorry, we're out of it.
Never before has the American taxpayer been asked to take on such a big burden all at once. $700 billion to shore up a financial system on the verge of collapse.
A lot of people have heard about what's called the bank bailout. It's technically called the TARP program. The reason healthy banks were forced to take TARP is Bernanke, who was head of the Federal Reserve, was afraid that if he just bailed out the bad banks, that would mark those banks. So he very much wanted the healthy banks to participate, so it looked like a bailout of the industry instead of a bailout of banks. And the good banks, like BB&T, would be painted with the same brush as the bad institutions.
All banks were forced to take a bailout loan from the government, whether they needed it or not. This policy hid which banks had made poor financial decisions.
In BB&T's case, we didn't need the money. We had to pay a very high interest rate, and the net cost is between $50 and $100 million for money we did not need and did not want. The myth that deregulation and greed on Wall Street caused the financial crisis and the government stepped in and saved the economy is not true. Unfortunately, government policies which had good intentions, like affordable housing, created very bad outcomes. When government starts interfering with market processes, it often produces very bad results, even when their intentions sound good.